Yeah, in this session, let's look at the various mechanisms that we have to assess the quality of the financial statements and how the financial statements get manipulated. What are the reasons for that manipulation, and how the accounting rules themselves, right, accounting standards themselves are creating mechanisms for manipulating or tampering the financial statements. So all these things, and along with that I would also like to look at what are the key areas in the balance sheet as well as in the income statement where there is a possibility of manipulation coming up, and how that can have an impact on the sustainability of the earnings of the company, and how can a financial analyst typically extract those kind of issues or identify those kind of manipulations, and what can he do to come out with a much better analysis. So these are some of the key aspects that I am going to deal with in this session. So just getting started, the whole problem with this quality of earnings comes from the fact that the financial statements are prepared on an accrual basis, not on a cash basis. In the cash basis accounting, everything is straightforward. The moment you collect your cash, you treat it as a revenue. The moment you spend cash, you treat it as an expense. So, of course, there are so many disadvantages with that. The reason being, okay, today you have purchased a very big machine or an equipment. There is a big, you have spent cash for that. So you have spent very heavily today, so there is a huge cash outflow today. But that machine you are going to use for the next 10 years. So that machine can actually generate revenues for the next 10 years. If I am using cash based accounting, the whole expense for this machine is in year 1, whereas when I am using accrual based accounting, I am able to spread the cost of the machine from year 1 to year 10. I mean, that's a better reflection of the performance of the company rather than showing entire thing as an outflow in the year 1 itself. So in a way, the accrual based accounting has given much more flexibility and much more better and timely information to the analyst or to the investors, whereas in the same process it has created a lot of loopholes, because the entire accrual based accounting is subjected to various estimates. We have looked at that companies can use their own inventory valuation mechanisms. Companies can use their own depreciation based mechanisms. Right, we have also seen that some kind of estimates are necessary towards warranties or towards bad debts. So there are so many provisions that are going to, or even for the pensions we have looked at, there are so many assumptions the company has to make. Even the stock valuation, the stock option models, how do you evaluate the option? There are so many inputs that are going into it, like volatility of the option, of the underlying security, the risk-free rate of return. So everything, there are so many items that are going as a part of the estimates in an accrual based model. So and most of those estimates are at the discretion of the management, which means the management will try to play around with those estimates and try to manipulate the financial statements to suit to their benefits. Though accrual based reporting gives more and more stable and consistent kind of earnings every year, we have to be slightly careful, and as analysts we have to be more and more critical in terms of dissecting those kind of manipulations which the management can do with those financial statements. If we are able to identify any possible manipulations from the perspective of the management, it would really help us out in doing more and more better analysis and provide more and more better recommendations as investment analysts to our customers. So from that dimension, we talk about how do I really assess the persistence of the earning. When I use the word persistence, I also talk about the word called sustainability. Okay, whatever the earning that the company has declared this year, can it maintain a similar level of earnings? Earnings are nothing but net income for me. So whatever the level of earnings that it has declared in this particular year, are those earnings sustainable over the next few years? That is what is the measure of persistence or measure of sustainability of the earnings. So the way I always look at it is, whatever the income, net income that is coming from the accrual based accounting mechanism, I break it up into the cash component. How much out of this accrual income is received in the form of cash, and how much of it is yet to be received in the form of accruals. The entire net income, I will find out how much of it is received in the form of cash, which I can get from the cash flow statement, and how much of it is yet to be received, which is an accrual component. Now I will see how much percentage of this and percentage of this. If this is more, if the accrual component is looking like more and more, means the proportion that I am yet to receive is very high, which means the persistency levels are much lesser, because if I get more proportion in cash, I have already received whatever the income that, whatever the profit that belongs to me, I have already received that profit. So there is a lot more sustainability there. But where accrual component is very high, the sustainability will go much lower. So that can be a measure which an analyst can use to talk about the stability and sustainability of the earnings. But of course, sometimes not just these kind of manipulations, but I also see the unintentional estimation errors also can result in issues with the persistency. Probably the management having a very optimistic estimate about the receivables and allocating very little towards the bad debts. So some such kind of optimistic kind of assumptions, estimates also could result in the problems with the persistency. But in any case, it is advised that the managers or the analysts should typically look at the percentage of the cash component and accrual component, so that they can assess for the sustainability much better. So whenever you are trying to do the valuation for a firm or evaluating the performance of a firm, for the cash component you can give more weightage, whereas for the accrual component you can give less weightage, and finally arrive at the overall performance evaluation of the firm. So there is a quantitative way of assessing the earnings quality also, quality of the net income, whatever we have received. So there is a balance sheet based approach. There is what we call as accrual ratio, which we find out. There is, we can find this out from the balance sheet elements, and also we can find it out from the cash flow elements. So whatever the mechanism I am using, in case I am getting a higher ratio, higher accrual ratio, means accruals are forming a very significant proportion of my total income, which means the sustainability of my earnings is at stake. So I'll take a very small example to work out how I can compute the accrual ratio and then come out with the interpretation regarding the same. Now let's take a balance sheet. So the balance sheet mechanism also is saying the change in net operating assets by average net operating assets. So how do I know what are my net operating assets? In the process of computing net operating assets, it is from the assets part. From the assets part of the balance sheet, only remove cash, keep all the other assets. And from the liabilities part, remove short-term and long-term debt, which are related to the financing part. So the other way of looking at is any items that go into cash flow from operations and cash flow from investments. That's the interesting thing here. Any items that go into cash flow from operations as well as cash flow from investment from the balance sheet, include them for the computation of the net operating assets. Anything that goes into the financing activity, remove them as a part of the cash flow from as a part of net operating assets. So from this, if I look at one Excel sheet for the same, here I have taken balance sheet for 2 successive years and income statement. So from the balance sheet, if I want to find out the net operating assets of 2011, how do I get it? From the assets. These are my total assets. From this total assets, if I remove the cash, it becomes total assets which are used in the operations. Total assets, total operational assets. I don't say net operating assets. I say total operational assets. And from here, I subtract from the total liabilities. From the liabilities side, I will use only the current liabilities. So I will not include long-term debt and short-term debt. So probably I could have either I take the addition of all these liabilities and subtract short-term and long-term debt, or I can simply subtract this accounts payable, saying this is my net operating assets for the period. So total operating assets minus total operating liabilities. Total operating liabilities are the total liabilities minus anything to do with the financing, which is more of short-term and long-term debt. So the net operating assets in 2011 is going to be something like this. The net operating assets of 2012, I can do the same thing. Net operating assets of 2012, again the total assets of 2012 minus cash of 2012 minus the current liabilities, or which is accounts payable being a current liability, we say net operating assets is this much. And average net operating assets, you can very well find out, right? I'll take the average of these two numbers giving me the average net operating assets, and from here I can find out my accruals ratio is the difference between the net operating assets of the two periods divided by the average net operating assets. So almost 41% is in the form of accruals, which means there's a lot to be received, which will create a huge issue for me if at all there are competing firms whose accrual ratios are much lesser. The higher the accrual ratio, the lesser is the sustainability of the earnings. So here, from here also, if I want to know what is my cash flow from investments exclusively from here, if I am looking at the cash flow from investments, right, probably let's look at the cash flow from operations, where I will take net income plus depreciation minus increase in current assets. So minus of what I will do is increase in the current assets. So total the current assets which I will consider is accounts receivable and inventory. So this minus this, which is what is the increase in the current assets. So to that extent I will have a decrease in the cash and plus increase in the current liabilities. So this is an increase in the current liability. So this is what is giving me my cash flow from operations, right? So the cash flow from operations coming out to 3,250, and when I look at cash flow from investments, it is coming out as the difference. So I'll take the negative of increase in fixed assets, so giving me minus 4,000 is the cash flow from investment. So when I want to find out accruals ratio using the cash flow method, all we do is net income. So net income minus cash flow from operations minus cash flow from investments. This is what we take in the numerator, divided by the average net operating assets. So even this will give me a similar kind of a response, around 41.46%. So whether I do it using the cash flow based or using, so when I am doing with the cash flow based, I will subtract the cash flow from operations as well as cash flow from investments. Only cash flow from financing is left, because I can use the cash either for operating purposes or for investment purposes. So I want to see by what extent is my net income above those numbers, and if that number net income is very much higher than these two, it's a very big indicator that my earnings are not sustainable. They got manipulated to some extent, and the consistency or sustainability cannot be maintained over a long run. So that is how we use the accruals ratio. And when I am comparing two companies on the quality of their financial statements also, I would look at this accruals ratio. The lesser the accrual ratio, the better is the quality of the financial statement. That is how we typically evaluate the persistence or the quality associated with the financial statement. Now, the higher the ratio, we said there is a possibility of some kind of manipulation or some kind of cook-up exercise happening on the financial statement. So from that perspective, if I want to see why do this company's management get into this manipulation process, they have so many incentives as well as pressures. There is a positive side as well as a negative side. The incentive is probably their compensations and salaries and bonuses is linked to the stock price. So only if the profitability of the firm is more and more, the stock prices in the market will go up, which means their compensations also are going to go up. So there is a personal stake that is associated with the stock price and thus the profits of the firm. So obviously the management will think of doing some kind of manipulations. And even from an investors community, it is like a company generating even a small profit There's a very thin line of difference. Let's say this is no profit, no loss. This is a very small profit, this is a very small loss. People prefer listening to this information more rather than this. Though the gap between these two is much lesser, people want to see that the company has made at least a very small profit rather than saying we have made a very small losses. So even from that standpoint, companies feel, why don't we adjust this small number? And even the analyst expectations. It's always the companies feel that it's better to cross the analyst expectation a little bit rather than falling short of his expectation by a little bit. Again, a similar, because that though the difference is very small, it will have a huge impact on the market and the stock prices. So the companies really prefer going towards the positive side rather than the negative side, which will make them get into the manipulation process by trying to understand some of the loopholes existing at some point in the preparation of the financial statement. Sometimes there could be contractual provisions like probably as per the bond indenture, the company has to generate a gross profit or net profit margin equal to some X. If they don't generate, then probably the bondholders have the right to call back their shares the bondholders have the right to sell back their shares immediately. So some such kind of pressures on the company also could come up, which is one of the key reasons why the management thinks to keep up with the contractual provisions like bondholders requirements and all. They would like to get into this kind of manipulation exercise. So from the company's standpoint, what are the different ways that are available to make sure that the company is not getting into such kind of processes? An independent audit can be performed at regular intervals of time, and the auditor's opinion will create some kind of careful attitude in the minds of the management, that if the auditor gives an adverse opinion, it will act very wrongly on the reputation of the company. So getting a company audited by an independent auditor at regular intervals of time creates a kind of a fear in the management towards the manipulation of the financial statement. Similarly, the board of directors can play a very active role in terms of making sure that the company is following good practices and not doing manipulation, because they can constitute an independent audit committee which can do a regular day-to-day audit and identify the manipulations quite earlier before they are detected via an external audit. And at the same time, nowadays it has become a practice that every financial statement that is getting released needs to be certified by the CEO and the CFO, saying that it adheres to the various accounting standards and principles mentioned either by the US GAAP or by IFRS, whatever is the standards they are following. The final statement should be given by the CEO and the CFO that the financial statements are adhering. Sometimes the fear of loss or even the fines and criminal prosecutions which can be set by the regulators create some kind of a fear among the management in terms of manipulating the financial statements. Or sometimes we see some special fraud evaluation kind of companies or business journalists or even financial analysts, they keep constantly checking out for companies which are getting into the manipulation exercise. They blow up the entire manipulation process, which will do more harm to the company rather than actually manipulating the financial statement. So this also makes this also deters the management to go forward with respect to the manipulation. So these are some of the things that we need to be comfortable with. And a good thing for an analyst to look at is a high earning in this period doesn't mean that very high earnings can be generated in the next few periods also, because very large extra earning, though it's not a manipulation exercise, even in one period if I look at a very large earning, it is expected that the earnings will follow a mean reversion kind of a behavior, because of which it is expected that even if the earnings are very high today or very low today, that cannot be sustained for a long time. They will exhibit a kind of a mean reversion behavior. So what we see is, if the accrual ratio is very high, the mean reversal is very faster, and vice versa. So that is one more thing we can link with the accruals. Okay, with respect to the accruals, this time if the earnings of the company is very high and the accrual ratio is also very high, I can very well predict that the next period earnings, or probably the earnings over the next couple of periods, they are going to come down. And looking at the possible areas of manipulations, okay, these are all the things the analysts can look at for identifying the possible manipulations that could exist in the financial statements. Okay, with respect to the income statement, the revenues, it may be possible that there could be very accelerated revenue growth. Sales of this year are much higher compared to that of the last year, right? Probably the company is showing a very high number in the revenues compared to the last year. Let's look at it. Okay, here we don't have the last year numbers, but if at all the sales of the last year or the sales of current year showing very high compared to the last year, compared to the peers, where the peers and competitors are growing at 15%, your company has grown at 40%. This is an alarm. Possibility of manipulation. So what should you do? Go back to the accounts pay receivables and see the growth in the accounts receivables. So the accounts receivable increasing means receivable turnover ratio will actually go down, because receivables turnover is nothing but sales by accounts receivables, right? So if the receivables has gone up drastically, the receivable turnover will go down and the days sales outstanding will actually go up. If you see that this days of sales outstanding is going up very drastically, you can very well sense that there could be some kind of a manipulation. So when you are doing the forecasting, or when you are doing the evaluation of the firm, when you are projecting the futuristic income statements and balance sheets, you can think of these things and get into the necessary modifications so that a better valuation of the firm can be done. Similarly, that's where if the receivables are changing very drastically, forget about only looking at the days sales outstanding, but if the receivables themselves are changing quite drastically, it means I could have booked it as a sale but did not get any cash for that. So that kind of thing could really impact my quality very heavily, because there is a possibility that you may not receive the cash for some of those sales. Next year you may have to look out for a sudden surprise regarding that. This is a very good thing which is worth looking at. Bill and hold arrangement. I have billed my customer, so when I have billed my customer, obviously I can recognize it as a revenue, right? But I did not dispatch the goods. Bill and hold. I did not dispatch the goods, or I have dispatched it to a wrong location, so that next year at the beginning of the next financial year I will dispatch it. So all these kind of things where you have really book them as revenues, but you have not received anything, especially if these kind of things come towards the end of the year. For a non-seasonal kind of a firm, these are some of the things that needs to be evaluated quite in depth. And the companies sometimes may get into a barter transactions to manipulate with the revenues and showing abnormal sales growth compared to the competitors. All these numbers have to be critically observed by the analyst to identify the possible manipulations in the financial statement. Similarly, with respect to the expense, you see what assumptions the company is making. Are they inconsistent with the industry? Are they consistent with respect to the previous years? And are there any changes in these assumptions over the last few periods? Because if at all there is a change, you need to really understand for what reason the company is changing those valuation mechanisms. So let's say instead of straight line depreciation, the company has moved to unit of production based depreciation, or it has increased the salvage value, or it has decreased, or it has increased the useful life of the asset. Automatically the depreciation is going to come down, which will increase the net income of the company. So look out for those kind of modifications the company has done from the footnotes. Same thing with respect to the inventory costing mechanisms, and at the same time look at any drastic changes to the fixed assets or the inventory accounts. Right? If there is a huge change in those numbers, there is a high possibility that the sustainability of those can have to be suspected. So from that standpoint, look out for days of inventory on hand. The too much larger inventory on hand can increase the days of inventory on hand, and it may so happen that that entire inventory will become obsolete and finally may have to be sold off at a much cheaper price, resulting in the net incomes going down quite drastically. And if at all that firm has gone into some LIFO liquidation, we have already seen earlier, in case of LIFO liquidation, I can very well reduce my cost of goods sold and show a very high net income in the year I have done the LIFO liquidation. But what has to be understood is, in that particular period my net income can go quite drastically, but in this process my inventory will go down quite drastically, which could also result in non-sustainability, because from the next year onwards I cannot use this kind of a benefit to show high net income because I am running out of my inventory. So it so happens that the next year the cost of goods sold may have to go up quite drastically, which will create the other position for the company. So from that perspective also, it is advised that the analyst really needs to check out for such kind of things from the footnotes to make sure that the assessment of the company is done much better. And there could be some kind of manipulations that can happen on the balance sheet as well. Companies can very well classify all the capital leases or financial leases as operating leases. So that will make the balance sheet lighter, assets will go down. So some kind of ratios like return on assets and all will typically go up. And because the balance sheet is becoming more and more lighter, the debt is also going more and more lighter. So comparison becomes more and more of a difficulty. So it is advised that for an analyst, if at all he finds more and more operating leases on the balance sheet, better convert all the operating leases as capital leases, and based on the data that is available, information that is available as a part of disclosures in the footnotes, convert all the operating leases into the financial leases for the purpose of analysis, and then use that for the valuation of the firm. Similarly, companies can play around with the goodwill. they don't impair the goodwill, though there is a huge impairment in the goodwill, they don't get into the impairment process at all, which will increase, keep showing their net incomes much higher, but every year there is some kind of impairment that is coming because of the goodwill. So companies don't want to show such kind of things as a part of their income statement and the balance sheet. The balance sheet does not get reduced because of the impairment of the goodwill, and they don't book losses corresponding to that. So from an analyst standpoint, it is worth to check out those kind of items, especially if the book value of the assets of the firm are much larger than the market capitalization. In that case, it is advised that the impairment of the assets need to be thoroughly checked out for. And sometimes what the companies may do is they create SPVs, they sell out some of their assets to the SPV, sell out account receivables or something to the SPV for a huge value. So in a turn their assets are going down and it's sold for an inflated amount, which will show a gain for that particular year. So the moment it is showing a gain in that year, probably they are showing net income very high, which is resulting again in the better performance of the company. So as an analyst, you check out if any SPE based transactions have occurred and any of the assets are transferred to the special purpose entity at an inflated amount. The other thing that companies can typically do is they play around with the valuation allowance, which is more like they decrease the valuation allowance associated with the deferred tax asset. So if the valuation allowance is decreased, the deferred taxes will go up. So this year's taxes are going to go down, which will increase the net income. Again, they can play around with that. And even the intercorporate investments, we have seen, if the investments are in the range of 20 to 50%, we'll use equity method, and anything more than 50% will use the acquisition method. Now, and we have also seen that in the acquisition method, the assets and liabilities 100% are consumed. On the of the subsidiary, the 100% of the assets and liabilities are consumed onto the parent's balance sheet, and one item for minority interest or non-controlling interest is created at the bottom. Whereas when we are using the equity method, we have also discussed that the company need not consume the liabilities of the subsidiary. It is not consuming the debt of the subsidiary, but it is taking only the equity, because there is only one entry for the equity on the balance sheet, which is increasing because of the increasing in the investment asset account. And similarly, it does not need to consume the revenue and the expenses, but it consumes only the net income. So even there, the profitability margin and these kind of ratios are going to go up. So it will impact the net income positively, but it will not impact the revenues of the firm more. So there is a kind of increasing attitude towards using the equity method, even though the control is more than, even though there is a significant control, even though there is a stake of more than 50%, companies try to go ahead using the equity method for representing their financial statements because of these things. So as an analyst, again, it is worthy to focus on all these aspects to make sure that the earnings of the firm are of high quality, right? So all these things have to be put into practice for assessing the worthiness of a particular company for the investment purpose, and for projecting the sustainability of the earnings of the company. I hope this has given you some amount of insight into understanding the quality of the financial earnings of the firm. In case you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have given here, Along with that, you could also send an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.